Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending August 5th, 2022. Appreciate you all tuning in to this channel and subscribing, and don't forget to hit that bell. Now this week I'm going to title the video Earnings Growth Keeps Markets Buoyant. And I want to touch on our earnings season because we are pretty much through it. 87% of companies, this is from FactSet, okay? So earnings growth rate for the second quarter is higher today compared to the end of the last week and compared to the end of the quarter. So this is a week where we had incrementally more earnings come out from the S&P, and overall it improved the quarter. So we had a good earnings week overall. Year-over-year basis, it is showing the lowest earnings growth for since Q4 2020, but that is mainly because of base effects. And this is something most people don't focus too much on is, looking at year-over-year numbers, year-over-year growth, but are those comparisons easy or are they difficult? And the second quarter is very difficult because there's a lot of stimulus in after Biden's inauguration, right? They gave out $1,200 stimulus checks and all these things that a lot of people to go out and to spend money, and that certainly helped earnings. And so when you don't have that for the second quarter, and now you're starting to compare the second quarter economy to this of 2022 to the second quarter economy of 2021, it's more difficult. It's more difficult comparison. So that's why you're seeing that earnings growth being so slow. But I look at it the other way. I say the fact that we could actually grow earnings despite so much of the stimulus coming off, to me, is a pretty good sign overall. Okay. Now, like I said, 87% of the companies have reported, and 75% reported actual EPS above estimates, which was a tick up from the end of last week. It was only 73%. So more than 73% beat this week. And so this was an upbeat week for earnings. Now, here it is, blended earnings growth rate for the second quarter, 6.7%. So, 6.7, that's not great. But last week it was 5.8. So once again, it's showing earnings are coming in even better for this latest week. So a lot of good news. 6 to 11 sectors are reporting year-over-year growth: energy, industrials, and materials leading the way. Financials, consumer discretionary, consumer communication services, those were the weakest. So these are always interesting. And here, forward P ratio 17.5, which is below the 5-year average. Now interest rates are probably right around the 5-year average. Let's pop over there real quick, because that's always a factor. It's not SPX. I want TNX. That's what I want. That's always a factor. Is the higher interest rates are, the lower multiples assets are going to trade for, whether that's stocks or that's real estate. Interest rates have a huge impact on the valuation multiples that assets trade at. And so let's go to the monthly. So 5 years, go back to 2017, right in here, right? So we're definitely on the high end of that. So, right, of this range. So to say that we should be at the lower end of this 5-year P range, it's probably right. Okay. So based on that, just simple back of the napkin type of analysis, I would say the market's roughly fairly valued. I don't think it's expensive. I don't think it's cheap. One thing I keep harping on, which it to me is very important, is with all the talk about a recession, a recession that's driven mainly by high inflation is very different than a recession in a low inflationary environment. Why is that? Well, think about what a recession is. It's 2 negative quarters of GDP growth. Of real GDP growth. And so mainly the first and second quarter, we're in a recession. GDP growth was negative. Real GDP growth was negative for those 2 quarters. That is technically a recession. But that has more to do with inflation being high, right? Because the real is subtracting nominal and then subtracting inflation from the nominal rate. And remember, what prices you see in the market, the S&P, those aren't nominal terms. Those aren't real terms. Those are nominal. Okay? They're not adjusted for inflation. And so while you have a quote unquote mild technical recession, you're still having earnings growth. Why? Because earnings are priced nominally. If you take out inflation, earnings growth is negative, right? If you subtract inflation, earnings growth is negative. So on a real basis, yes, earnings growth is in decline. But so is the economy. So it's kind of what you would expect. But remember, the markets are not priced in real terms. They're priced nominally. Okay, so I really wanted to hammer that home. Now let's get into the economic numbers. Payroll number came in month over month, 528,000 acceleration, certainly putting the market with a little less hope that the Fed will pivot aggressively. So that increased interest rates today. But underneath the surface, it was more of a ho-hum report. It wasn't as bullish as I think the headline number. Private hours worked were flat. Average earnings year over year were slight tick down, very slight tick down. And then you have unemployment claims that came out on Wednesday, and that was a slight tick up, almost to the highest of the year. So the jobs picture to me is okay. I think it's weakening at the margins, but not broad-based. And it's difficult to have a really rough economy with such low unemployment and still a lot of job openings and job creation. So, overall, it's a very mild deceleration in the economy overall. Certain parts, housing market, for example, things that are more tied to interest rates, certainly those are getting hit on the chin a little bit more. But what's interesting here is the consumer credit outstanding report. That's one that is always underrated for the first week of the month, is how much credit is the consumer taking out. And remember, everyone talks about the Fed creating money. Well, who creates more money than the Fed? Banks do. Banks have reserves, and they lend them out, and they have a 10-to-1 ratio. And so when they go lend into the economy, they're creating dollars out of thin air. That's the fractional reserve banking system. That's how it works. And so the fact that consumers are taking out more loans and it's increasing at an accelerating rate from June tells you that consumers are relatively confident. Banks are relatively looser with their credit standards, et cetera. And so that's obviously positive for the market as a whole. Then you get in the ISM numbers. You had ISM PMI. That was manufacturing PMI, slight deceleration, but still above 50, so still modest growth. And then same with services PMI. That actually accelerated slightly. And then the prices paid index, that actually came down. That's a good thing, right? So you have accelerating growth in business, and you have prices overall are coming down. And this is prices paid on the services side from 80 to 72. On the manufacturing, 78 to 60. The highest, biggest drop in 12 years or so. So overall, a mixed bag when it comes to the economic numbers, but certainly a positive outlook when you're looking at earnings coming in. And so I think that's really what made the market react pretty nicely this week, despite higher interest rates. Now let's look at that. NYSE really had a choppy sideways week, just consolidating right at this 382 retrace from the high of the year through the low of the year. And I expect this to probably get even higher. I think on the next level, 50% retrace, 15,710 would not shock me with the NYSE. That's another about 3.5% from here. Definitely would not shock me. The S&P, let's bring up the S&P real quick. That one's consolidating right at this 100-day moving average, and this is a resistance zone. So we chopped sideways. We had bullish consolidation here in late May, early June, and we failed. Okay, we failed. And we're back up into that zone. And so naturally that's going to be some overhead resistance. Just look at this blue over here. This is volume at price. So what this means is how much volume has been transacted at that level. And guess what happens? It's natural. People were down and now it goes back up and people will break even. What do people do? When they're down, they typically say, oh, I'll wait till I get break even and then I will sell. And that is natural supply, overhead supply. And so just consolidating here, healthy, fine, nothing really wrong, technically, at least in the near term. Now, some interesting parts of the market were relatively steady despite higher interest rates. ITB, the home builders, kind of a flat week on higher interest rates. And I'll bring that up here real quick, TNX. All right, so we started the week down here, right around 226, 265, ended at 285. So about a 20 basis point increase in interest rates, the 10-year, during the week. And so you would think that would be a headwind of the market, but like I said, earnings are coming in fine. Economic numbers kind of came in where it pleases both sides. Hey, inflation's coming down, but the economy is accelerating, or at least not falling off a cliff. And so kind of a Goldilocks week overall. And what was interesting to me was higher interest rates typically bad for gold. Gold had a good week. It was a flat to up week on gold, and a good week for GDX. That was also flat up. And I'm continuing to watch this. The GDXJ to the GDX. Money is flowing into these miners. Look at this. Above the 200-day moving average now. That is a strong indication that we're in some sort of inflection point. And the fact that, we had these good jobs number and the gold actually shook it off tells me the sentiment in the gold market is very, very negative. And you see with stocks, remember how negative sentiment was in early July? It was really bad. And all that did was set up the situation for a nice rally. And then the dollar, I'll get to real quick. The dollar had an okay week, but you would think with good jobs, data, inflation coming down, all these things would increase the dollar. It didn't. It really didn't. And then lastly, I want to look at DBC to the SPY. So these are commodity index. Look at this. Commodities are pulling back, especially in relation to the S&P. So I think this is a big factor as well that's getting the market a little more bullish, saying, hey, commodities aren't running away. They're not going to push in the inflation figures higher over the next 3 to 6 months, because that's really what happened earlier in the year. Look at here. Let's cut off Ukraine, right? Commodities were in a bull market, but this really the situation in Ukraine really pushed commodities much, much higher, and I think this is a natural pullback. I think it's fine, but the fact that we're not getting this continued runaway in commodity prices is overall good for the economy, because cheap commodities makes business more efficient, makes business more profitable, makes the economy more sustainable and healthy. And so as long as you get a pullback in commodities, I think that's going to give some nice upside to the market overall, at least in the near term. Now, where do we get as we get into the fall? That could change. But I think the month of August is likely to be bullish, just as kind of I predicted. A nice, decent bounce in July into August. And now, as we set up here, we're in a healthy position in the short term. But that all can change, obviously, with Fed stance, with economic data, with changes in trends in commodities and interest rates, etc. But right now, overall, healthy setup. I think that does it for me this week. I appreciate you all tuning in. And a reminder that the contents of this video are provided for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Thank you all, and have a good night.